Welcome to Iron Financial. This is the place where we forge stronger portfolios by putting companies through the ultimate stress test. I'm your lead analyst. Today, we are putting ZoomInfo, ticker GTM, right under the microscope. Now, this company just dropped a set of numbers that, on the surface, look like solid steel. But the market reacted like it found a massive fracture. So we're here to find out which one it is, a foundation of pure iron or a structure that's just riddled with weakness. Let's go ahead and fire up the forge.
Every earnings season throws a few puzzles our way, but what happened with ZoomInfo? Well, it's a genuine paradox. We're not talking about a little miss here or some slightly weak guidance there. No. This is a case where the headline numbers looked really strong, yet the market's reaction was just swift and brutal. It's that kind of disconnect that absolutely screams for deeper analysis. It's a signal that something under the surface just isn't adding up for the big money investors, and it's our job to find out exactly why.
Okay, let's get right down to it. The tail of the tape for the fourth quarter of 2025. And look, the numbers, just on the surface, they tell a story of a clear, undeniable victory. Wall Street was looking for earnings per share of 28 cents. What did ZoomInfo deliver? 32 cents. That's not just a rounding error, folks. That is a solid beat. Then you look at the revenue side. The consensus was sitting just over $309 million. They came in hot at $319 million. Again, a clear, decisive beat. By any traditional metric you want to use, this is a winning quarter. The company executed. They delivered more profit and more revenue than the street ever expected. So, case closed, right?
A winning quarter? Really? Then explain this to me. The second those so-called winning numbers hit the wire, the stock got absolutely hammered in after-hours trading. It dropped a full 6%. That's not what a celebration looks like. That's a punishment. So the central question we have to answer today is really simple. Why on earth would the market punish a company for beating expectations on both the top and the bottom line? Is this all just hype, or is there something real, something deeply concerning that the market is seeing that we're not?
All right, before we get into the really heavy lifting, let's just lay the foundation here. For anyone out there who might be unfamiliar, ZoomInfo is not the video conferencing company. No, they are a titan in what's called the go-to-market intelligence space. What that means is they provide a massive cloud-based platform that's just packed with data and analytics that helps sales and marketing teams find their next customer. In a world that's driven by data, they are a key part of the arsenal for over 35,000 businesses trying to shorten their sales cycles and, of course, increase their win rates. Their entire business is about making other businesses more efficient. So here's the game plan for how we're going to conduct this stress test. We've already laid out the paradox, right? Next, we're going to build the bull case, piece by piece, examining the strong, ironclad pillars holding this company up. Then, our skeptic here is going to do his job and start looking for the cracks in that very foundation. After that, we'll analyze all the external and legal headwinds that are whipping around this company. And finally, we will weigh all the evidence and deliver our final verdict. All right, let's get to work. It is time to build the bull case. I want you to forget all the market noise for just a minute and focus with me on the fundamentals, the core structure of this business. We are going to look at the numbers that show a company with a powerful, cash-generating engine right at its core. These, my friends, are the steel girders holding this entire operation up. And we have to start with the top line. For the full year of 2025, ZoomInfo brought in nearly $1.25 billion in revenue. Now that is a significant, substantial revenue base. We're not talking about some little startup with a promising idea. We are talking about a major player with $1 billion-plus revenue stream. This right here is the bedrock on which everything else is built. It shows you they have a product that thousands of companies are willing to pay a lot of money for. Now, revenue is one thing, but profitability? Profitability is what really shows you the strength of a business model. And this is where ZoomInfo truly shines. For the full year 2025, their adjusted operating income margin was a staggering 36%. Let me just put that into perspective for you. For every single dollar of revenue that comes in the door, 36 cents drops right down to adjusted operating income. This isn't just a company that's growing. It's a highly efficient, highly profitable machine. That is the kind of margin that speaks to a strong competitive moat and some real pricing power.
And that high profitability, it translates directly into massive cash generation. For the year, ZoomInfo generated $455 million in what we call unlevered free cash flow. This is the furnace at the core of the company. It's just pure, unadulterated cash the business produces from its operations. And this is the money they can use for anything, paying down debt, innovating, buying back their own stock, or just piling it up in the bank for a rainy day. A company that generates this much cash has immense financial flexibility and real durability.
And hey, you don't just have to take my word for it. The company's own founder and CEO, Henry Schuck, he summarized it perfectly. He said, and I quote, "In 2025, we delivered record revenue, expanded profitability, and increased free cash flow." This is management telling you directly that the core financial engine is not just strong, but it is firing on all cylinders. They see the exact same picture of financial strength that we're seeing in these numbers. They're proud of this operational performance, and you know what? Frankly, they should be.
But profitability is only half the story, right? A key part of the bull case is the quality of the customer base. And here, we see a really clear trend. ZoomInfo is successfully moving upmarket. The number of customers paying them over $100,000 a year, it increased from 1,867 in 2024 to 1,921 by the end of 2025. These large enterprise clients, they are stickier, they are more stable, and they provide a much more predictable stream of revenue. This isn't just growth for growth's sake. It's a strategic shift towards higher quality, more durable revenue.
So here's the crucial point. What does management do when they see a powerful, cash-generating business with a stock price that the market is just punishing? They step in and they buy it themselves. The board just authorized a massive $1 billion share repurchase program, and that's on top of the hundreds of millions they already spent buying back stock last year. This is the ultimate vote of confidence. Management is literally screaming from the rooftops that they believe their stock is fundamentally undervalued. They are putting their money where their mouth is, period. Okay. That's a very well-built case. It sounds solid, I'll give you that. But every structure, and I don't care how strong it appears, needs to be tested for its weaknesses. Any good analyst knows you have to kick the tires. You have to stress the load-bearing walls. So it's time to stop admiring the architecture and start actually looking for the cracks in this foundation. And believe me, there are cracks. Let's start with the most glaring issue, the one that completely undermines that entire record revenue story you were just telling. Growth has hit a brick wall. Yeah, okay, they had a 5-year average growth rate over 21%, which is fantastic. But the past is not the present. For the entire fiscal year of 2025, revenue growth slowed to a crawl, just 3%. And what about the future? Their guidance for the next quarter is for basically zero growth, flat. A 21% growth engine has ground to a complete halt. This isn't a slowdown, it's a full stop. That's the real reason the market is spooked. So why has growth stalled? I mean, to really understand that, you have to look at a super critical metric for any subscription software company, net revenue retention, or NRR. This number tells you if the company is keeping and growing its existing customer accounts. If you have an NRR over 100%, it means your customers are, on average, spending more with you each year. But an NRR below 100% means you are leaking revenue from your existing customer base. It's a fundamental health check for any SaaS business.
And ZoomInfo's number is 90%. Let's be crystal clear about this. For a company in this space, that is a weak number. It means that for every dollar of revenue they had from their customer base at the start of the year, they only had 90 cents left by the end of it, and that's before adding any new customers. They are losing 10% of their revenue from existing clients through some combination of customers leaving entirely or just reducing what they spend. That is not the sign of a sticky, indispensable platform. It's a significant crack in the armor, and it forces them to run twice as fast just to stand still on revenue.
Now, let's talk about that highly efficient machine you were so excited about. While revenue growth was slowing down, some of their costs were absolutely exploding. If you dig into their 2024 annual report, general and administrative expenses shot up by 64% year over year. That's a massive increase in overhead, from legal costs to all sorts of administrative functions. Yeah, the report blames things like lease impairments and bad debt charges, but a 64% spike in G&A while your growth is decelerating? That raises some serious questions about operational discipline and cost control. But the biggest crack of all? It's not visible on the income statement. No, it's buried deep in the financial footnotes. It's something called a tax receivable agreement, or TRA. Now, this is a complex financial instrument, but here's the simple version. It's an agreement the company made before its IPO to pay the original owners 85% of the value of certain tax benefits the company gets to use. Just think of it as a massive long-term IOU to its founders and its early investors.
And how big is that IOU, you ask? As of the end of 2024, the liability on ZoomInfo's balance sheet for this one agreement was a staggering $2.76 billion. Let that sink in for a second. The company's entire market cap right now is around $2.3 billion. This is a liability that is larger than the public market value of the entire company. It's a massive weight on the balance sheet, a contractual obligation to pay out billions of dollars over time that will drain future cash flows away from public shareholders and straight into the pockets of the pre-IPO owners. This isn't just a crack. It's a potential sinkhole right under the foundation.
And it gets worse. The internal cracks we've just identified are being made significantly more dangerous by a storm of external pressures. This is not a company operating in a calm, stable environment. Oh no. They are facing significant headwinds from both the economy and the legal system, which threaten to widen every single one of those fractures we just talked about.
And look, this isn't my opinion. This is coming directly from the company's own risk disclosures in their 10K report. They explicitly warn investors about a whole laundry list of macroeconomic risks. They're seeing customers reduce spending. They're experiencing longer, more difficult sales cycles. Their own clients' budgets are being squeezed by inflation and higher interest rates. This is the tough environment that helps explain why growth is stalled and why customers are cutting back. The economic tide is going out, and it's exposing all the rocks.
On top of that economic storm, there is a legal one. And this isn't some single one-off lawsuit. This is a clear and persistent pattern of legal challenges. It started back in 2021 with class actions in Illinois and California, and then it escalated in 2024 with another one in Washington state, and, most seriously, a securities fraud class action. These lawsuits attack the very core of ZoomInfo's business model, how they collect and use data, and they raise fundamental questions about their business practices.
And that securities lawsuit? It contains the most damaging allegation of all. It accuses the company and its senior leadership of omitting truthful information about its customer base and renewal practices from its SEC filings. In plain English, they are being accused of misleading their own investors. Now, of course, the company says it will defend itself vigorously. They all do. But an allegation like this, it strikes right at the heart of investor trust. It suggests that the numbers we all rely on may not be telling the whole story.
All right, the evidence has been presented. We've built the bull case on a solid foundation of profitability and cash flow, and the bear case has hammered away, revealing some serious cracks in growth, retention, and the balance sheet. It's time to step back, look at the whole structure, and deliver our final verdict.
Look, you cannot deny the core financial engine here. A 36% adjusted operating margin and nearly $500 million in free cash flow is an elite financial profile. That is a foundation of iron, and management's billion-dollar buyback shows they are willing to bet heavily on that foundation. But you can't build a skyscraper on a foundation if the ground underneath it is crumbling. Stalled growth isn't some minor issue. It's an existential threat to a company that's valued like a growth stock. A 90% NRR shows that customers are finding reasons to leave or spend less, and that $2.76 billion TRA liability isn't hidden. It's a disclosed financial obligation that's going to act as a massive anchor on future cash flow for common shareholders. You add in the pattern of serious legal risks, and the whole structure starts to look incredibly unstable, regardless of the core profitability. This is a classic battle between a strong business operation and a broken stock story.
So, the final verdict, the bulls, they see a fundamentally sound, cash-gushing business that is temporarily struggling with a tough macro environment. They see this stock price as a massive overreaction and the buyback as a clear sign of deep value. To them, it's a solid structure that's simply under repair. The bears, however, see a much, much darker picture. They see a broken growth story, weakening customer loyalty, a balance sheet that's encumbered by a massive liability, and a company besieged by legal challenges that question its core practices. They see a value trap, a foundation that looks solid from a distance but is actually poised to crumble under the weight of its many problems. So the question we leave you with is this. Is ZoomInfo a high-quality structure that's on sale, just waiting for the economic weather to clear? Or are the cracks we found today signs of a deeper structural rot that could lead to a total collapse? That's the billion-dollar question. Answering it correctly is how you forge a stronger portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.